Many mainstream analysts are predicting that stocks will recover soon. But one 20-year market veteran says we'll instead witness a cash frenzy unlike anything we've experienced in 21 years before stocks recover. And he's urging Americans not to buy a single stock until they see it. According to Dan Ferris, who gained acclaim for predicting the Lehman Brothers crash in 2008 and calling the top of the NASDAQ in 2021, this is the number one most important thing to pay attention to for 2023. And he's not talking about another market crash, politics, or inflation. As all this unfolds, the financial consequences could last for several decades if you don't understand what's happening. There will be winners and losers. Now is when you decide which one you'll be. This is why I strongly encourage you to read about his warning totally free today. Get the facts yourself. Go to marketdisaster2023.com to get your free copy of this report. You can learn how to get his 4 steps to prepare for what's coming. Again, that's marketdisaster2023.com for your free copy of his new report. Hi, this is Daniela Cambone. Happy New Year and welcome back to the Daniela Cambone Show here on Stansberry Research. I am kicking off the year with one of our all-time favorite guests on the show, Carter Braxton Worth. He is the CEO and founder of Worth Charting. He's also known as the Chartmaster and has been right on the money with many of the calls he had made in 2022. So what does he see in store for the new year? Carter, first and foremost, happy 2023. Nice to see you again. Welcome back.
Likewise. And thanks for having me back. A lot of fun as always. And as we all know, it's a lot of guesswork, predicting the future, as it were. But let's try.
Okay, let's give it our best shot. So we're going to try and give a well-rounded overview here for the folks. Like I said, last time you were on, you were saying that most likely we had hit peak inflation. You were saying we should be stockpiling cash. And there were 2 assets you said if you had to own, you should be owning. One of them was gold. So I thought, let's start with gold today because we're getting pockets of what seemed to be like a breakout moment for the metal. How is it set up for you so far?
Right. So we had a circumstance, right, where gold was down 7 months in a row. And you can go back to the late 1800s and not find that. And then since then, actually, gold has had a tremendous recovery. Not only that, but gold miners, as measured by either the Philadelphia Gold and Silver Index or the New York Stock Exchange Gold Bugs Index, are now up 4 months in a row. There is no other aggregate that has done that. Not any S&P 500 sector or mid-cap sector, no other bourse, no commodity, no other aggregate of any kind. And so relative strength is important. We know that if you consider all the factors that go into some of the great quant models, momentum and relative strength are very robust. And so gold has very desirable characteristics. Let's look at a few charts. I have some here and figure it out together.
Yes, please.
So I thought we'd start with why I think commodities in general, it has to go with peak inflation, are going lower. And we'll look at some of those charts and then juxtapose them against gold. And so here's, for instance, the iShares commodity ETF, GSG. It's one of 2. Here is a comparative with the Invesco Commodity Index Tracking Fund. So those are 2 very liquid ETFs that generally mirror the CRB or the Bloomberg Commodity Index. Now, if I put gold in, we see a circumstance that's quite clear. These have been winners and are now going lower. Gold has been a loser and is now going higher. And so if I pull that back even further, now here's a 2-year chart, it's quite straightforward. We have a circumstance where gold has been unhappy, unwanted, unloved, whatever phrase one likes, where the other ones were overbought, overloved, and now it's all reversing. And I think that's important because not only does one want to be long gold, but I think it's right to be short in general commodities. Now, here is individual chart of the iShares GSG. No lines, no judgments, no annotations by me. Let's put some in. Now that's a very clear trend line. Take it away, put it back. Take it away, put it back, put some arrows in. Meaning we have bounced off trend to the penny, to the penny, to the penny, to the penny. And once you break trend, if you throw back to the underside of the trend line, yes, you are a rally to a difficult level. And so what we have here is a perfect instance of something that's hit its head and is turning down. By contrastation, look at the DBE. It's the same circumstance. Or look at, frankly, the Bloomberg Commodity Index. Now, here's something interesting about this index. It's got a 15% weight in gold, and it's going down. Think if we took gold out of it, it would be even worse. And it just shows how bad this is. It all peaked right there on the spike in the Ukraine invasion. And you had Wall Street extrapolating $200 a barrel for oil, and everything would never end. It was the peak. And we've been going down ever since. So back to this comparative chart. And Danielle, let's look at now gold on its own, but with a relative performance on the bottom. So here's a simple 2-year chart of gold, and here's its relative performance to that Bloomberg Commodity Index. Now, what do we know? There are no lines here, but look, the bottom in relative, even as gold went lower and lower and lower all through the summer and autumn of last year, its relative performance was starting to turn up. So that's a very important circumstance. Look at it a different way with a moving average. Let's do the same thing longer term. Again, a 2-panel chart. It's gold on the top. It's relative performance to the entire Bloomberg Commodity Index, which has all the softs in it, from cocoa and cotton and sugar to all the grains like soybeans and corn and wheat. It's got industrial metals like copper and nickel and zinc. It's got energy. And what we know is this is a major turn, right? You have bull phases and bear phases in relative charts. And this has all the elements of a bearish to bullish reversal. So if we were to just look at the relative line, right? Again, it's gold on the top, relative performance to the Bloomberg Commodity Index on the bottom. Let's look at that chart on its own. So now we're just looking at one line. It's simply one thing divided by another. It's gold divided by the Bloomberg Commodity Index, which gives you an RS line. And it has all the elements of a turn. Now, instead of using an automated trend line, we can use an actual trend line. Ready? Yep. Actual, automated, actual, automated. And what do we know? It was a perfect double bottom, literally to the penny. And it has all the elements of a turn. I just think it's very important. I mean, maybe we do a little bit on gold itself. Does that make sense long term?
Yes.
So interesting here. We have gold at its low, right? NASDAQ was at its high, the dot-com peak. Nobody wanted gold. Everyone wanted Cisco. Cisco's the most valuable company in the world. Now it's a small thing. Let's put some lines in. We know there's a trend line, right? It's very clear. We can draw the lines this way. Doesn't matter whether you call it a wedge or an ascending triangle or it's all set up to break out. Another way to draw the lines, call it this, cup and handle. Yep. Call it a head and shoulders bottom. Or is it this, a big uptrend and a big consolidation, a big advance and a big rest?
Yes.
Put them together, that's all it is. A great move, you rest for basically a decade. You ascend for a decade, 2000 to 2010. You rest for a decade, 2010, 2020, plus or minus, and in principle, launch up and out. I really think it's great. And just one thing also, it's such a small asset. We know there's how many gold stocks in the S&P 500? One, Newmont. We know that there are only 8 or 9 in the entire Russell 3000. The Russell 3000 represents 98% of the investable capital in the United States. And there are 9 gold stocks in it. In fact, if you took the entire market cap seen here on the table of every single gold and silver miner in the Philadelphia Stock Exchange Index, they add up to $263 billion. What is that? That's about the same as Bank of America at 268. And what is that? Bank of America is 73 basis points weighting in the S&P. 0.75%. Gold is a teeny asset, and it doesn't take much money to move these stocks if money were to move into them.
So let me ask you this, Carter. You're making a very strong, very bullish case for gold here. Would you say that 2023 is the first phase of the new bull run for gold?
Well, how I would say, meaning I would say that whether you call the consolidation the end of a bull is not necessarily. I would characterize it as follows: that the great ascent, the decade from 2000 to 2010, plus or minus, has been, and the excess of that period has been worked off. And so in principle, after resting, you usually get resolved in the direction of the preceding move. So I would say it's a continuation of the bull, so to speak, or as you just characterized, a new bull. But the sell-off is minor, right, in the context of the preceding ascent. And so I would consider the entire past decade just a rest rather than a bear.
And we know the criticism that gold received in 2022, many investors were expecting it to do so much better given the geopolitical landscape. I've said this in other interviews. There's two ways to look at it. Other folks saying gold, beat everything else and was the best there was to pick amongst. But my question is, vis-a-vis the U.S. dollar, right? So much of it had to do with the strength of the U.S. dollar this year. In 2023, how do you see the U.S. dollar set up and its impact on gold?
Yeah, I mean, we're in the camp that dollar continues to go lower, but not much lower, to be fair. And we know that gold is making all-time highs in other currencies. Of course, there are many ways to look at that. So here's a chart of the dollar over the past 2.5 years where it's really been dynamic to the upside. No lines, no drawings, no judgments, no conclusions. Let's put some in. Take it away, put them back. We're almost down to the lower band, which comes into play at around 102, thereabouts. Now, at that point, we will be fairly oversold, and I'm thinking you'll get some stabilization in the dollar. If you look at this longer term, here's now going back to 1993, and put in lines like this. After breaking out from this well-defined thing, we've checked back to a level of support. Now, to be fair, support is not a plywood board or a concrete floor. It's a mattress top, and you sink into support before ultimately finding it. And so could the dollar move down, down into, again, as low as 100? Sure, but this sequence is not likely to go much lower before you get some stabilization. But independent of that, I don't think there's any reason that gold can't prosper and perform well. And certainly, to your point, relative to other things.
And let's add another layer there, the conversation of, inflation. You had said a few months ago when we spoke that we had hit peak inflation. Obviously, if you've seen the numbers cool off, where does inflation go from here? Has the Fed successfully fought it off?
Right, so there's a lag effect, as we know, to tightening, if you will. And so I think I'm in the camp, look, there's so many, there's the stagflation camp now, there's the it was going to be transitory. Of course, that turns out not to be true. All of these things. You have to pick a side, pick a direction. My view is that we've seen peaks in commodities, and you're seeing the rollover there. And that obviously, while labor is a big fact, labor and rents are still persistently high. Ultimately, there's a reason that 10-year yields aren't higher right now. Mm-hmm. It's because I think we have peaked.
And, just going back to commodities a second, we often see silver following in gold. We're seeing some breakout moments for silver as well. Are you as bullish silver?
Oh, yeah. I mean, sure. They're going to do the same thing over time, as we know. It's just a more aggressive beta play. It's smaller, even smaller still, and it tends to lag until all of a sudden it comes to life. Yes.
And Carter, we had spoken before the crypto carnage. I know at the time you obviously were saying gold, definitely a better inflation hedge versus the cryptocurrencies. I don't know if you have a chart handy on Bitcoin, but curious to get your thoughts on where Bitcoin goes from here.
Yeah, I could pull up a Bitcoin here. I mean, it's talk about left for dead. It's not even trading anymore. You can see it, right? It's flatlining, which is to say perhaps it's reached a level where it belongs, if you could use that phrase in this business, but not inherently interesting here and now, meaning, to my eye, no discernible opportunity on the long side or short side. Yep.
Okay. I don't think I could add anything to that. I want to talk about Carter's picks now for 2023. I know in 2022 you liked Beyond Meat. Curious to know what charts are looking strong to you as we start the new year.
Yes, let's do a favorite sector.
Yep.
Here's S&P 500 healthcare. Let's drill down on this. The thing about healthcare is it has offensive and defensive characteristics, right? And it's really, in many ways, the only sector that can claim that. So what we know is that defensive behavior, right out of page one or day one at business school, they say, when you're in trouble or the market's in trouble, you rotate into defensive type securities. And people still do that. The biggest mutual fund families and pension plans do. I talk to them all the time. And we know that you roll back the clock 100 years, there was no medicine. There was no medicine, right? There are guys walking around with jars of pills that meant nothing. Snake oil salesmen. And there was no defensive characteristics, healthcare, right? I mean, when they cut your leg off in the Civil War, they gave you a drink, you bit down on the piece of wood, and they sawed your leg off. That's not medicine. That's horrific. Here's my point. True defensive is what's known as soap and cereal. That's what it was described in the 50s and the 40s. We have biscuit companies that are 250 years old. So think of Nabisco, literally, and Post Cereal and Kellogg and Kraft. And then soap is things like Colgate-Palmolive selling and Procter & Gamble. So there is only one true defensive, utilities notwithstanding, but truly defensive sector, which is consumer staples, soap and cereal. But we now have something else in the last 30 to 50 years that's also defensive, which is big pharmaceutical companies that have ongoing cash flow. And I want to look at healthcare because it is both defensive and offensive because you have a lot of biotech. You have devices, growth areas of healthcare like Intuitive Surgical, right, that create robots to do operation and so forth. So this chart right here is an all-data chart of the S&P 500 healthcare sector on the top. And we're looking at relative performance to the S&P on the bottom. Let's put in some lines. Now look at this. Look at this trend line. Do we think that's random? And look, it's bounced off that. So this is so important for anyone who wants to spend time with charts.
Yeah.
Now one could say, how is that possible? Is it some trick? The healthcare sector, which is Johnson & Johnson, Amgen, and Merck, and Lilly, but also Humana, Managed Care, and United Healthcare, and Intuitive Surgical, and Stryker, and so forth, all these different biotech, and yet, why is it that the relative strength line stops and bounces to the penny? Do you think that's dividend discount model, price to sales, enterprise value to EBITDA, price? No, it's all technical. And the great quant models, they watch these lines, and where did healthcare bounce in 2021? To the penny. And what I think is about to happen here is that healthcare has been underperforming since 2015. I think it's going to make a new high, relative. And one could say, yeah, it hasn't come a long way. Okay, it's come up over the last year, but it's basically on a relative basis below where it was from 2015. This is still young in the making. Let me look at it another way. Now, here is healthcare relative to what I said was classic defense, right? Staples, Procter, Colgate, Church and Dwight, right? Kellogg, so forth and so on. And look at the relative line.
Look at that.
Healthcare is only now back to where it was at the dot-com peak.
Wow.
So healthcare has been ascending and ascending and ascending, but it's only now back to its relative highs of 22 years ago. To staples. And so let's put in some lines. A textbook setup for a breakout. And so there's no growth. Procter has no growth. Colgate has no growth, right? Coke has no growth. Pepsi has no growth. They're big tobacco, big sleepy businesses that have revenue growth of 2 and 3% a year that always trade rich, a higher multiple because they're safe. They are safe. People keep drinking Coke and keep smoking cigarettes or whatever else they're doing, keep washing their clothes, brushing their teeth. But healthcare has the same defensive characteristics, but it's got the offensive. And so an ultimate pairs trade is being short consumer staples, by my work, and long healthcare.
Makes a lot of sense. And Wow, that historical overview just puts everything in perspective. Um, let's stick to some individual stocks here. I want to get your thoughts on Tesla, Apple, and how the China risk is looming over these two. I mean, Kathy Wood still keeps adding Tesla here, but curious to get your thoughts.
Yeah, Tesla is, look, I mean, I've reversed a short on that, and I've got I think it's time to bet on the long side. We shall see. So no lines, no drawings. And what we have, and it's fairly straightforward, right, is the following. We are just down to the point where I think rebound potential is high. We have the same circumstance here on the top. Watch. I did from the high to here. It's the same thing, yes? So in the up phase, you stay within bounds. On the down phase, does it mean that Tesla can't go to 50? Go to 50, go to 0. But on a tactical basis, I'm a buyer for a bounce.
Okay.
Apple, not so good. I think Apple's good. Apple's so widely owned. It has all the elements of a major top. Don't like Apple.
You know, broader view, S&P overall, I've seen you in other interviews saying you could see some heavy selling at the start of this year. How come?
Yep.
Here's a 2-3 year chart, no drawings, no lines, no annotations. Let's put them in. Here again. Look at this. This is a great anathema to the Federal Reserve Bank, to the CFA Society, the Harvard Business School. They can't stand it. They're like, how is this possible? How is it possible that this S&P is stopping to the penny on the way up and on the way down? Because so much of it's about money flow. It's not about valuation. The S&P has had 3 counter-trend rallies. It's failed every time at trend. And for now, we're just in a downtrend. The longer term, let's look at this. This is the chart of the S&P from the 09 financial crisis low. You see the 2007 peak. We touched the lower band, and now we're sitting here at the middle. Let's put in some lines. Here's 2023, unknown 2024. Do we have to get down and touch the lower bound? Not necessarily, but I think that's a pretty good bet. So let's draw some lines. An arrow. What would that be? It would be 3,100.
Right.
What would that represent from here? About an 18% decline. Now remember, from peak to trough, that would be 35. Now that seems like a lot, but the NASDAQ 100 is already down 37% from its high. Why can't the S&P do that? So I would think that has to be on your corkboard, everyone's mind, yours, everyone's, to keep in mind as a perspective level to watch. And then let's talk about this, which is kind of fun. This is a quirk of the calendar, of course, but does the S&P have down years? It does. 94 years of history, 31 have been down, so it's not rare. But what is rare is having back-to-back down years. Red is down, you can see, of course, and black is up. Here are the only instances where you've had back-to-back. And they were epic moments, of course. So what does it take to get 2 years down in a row? It takes, well, it took the Depression to 29, 30, 31, 32. That's a major event. It was 3 years in a row. What was this? 39, 40, 40. That's called World War II. That's a major event. It was down 2 years in a row in 73, 74, which was inflation like nothing like we've seen now, and interest rates much higher, and OPEC and oil and so forth. And then, of course, it took the dot-com valuation and crash, 2000, 2001, 2002. Fairly rare to get back-to-back down years. My hunch is that's what's going to happen. But remember, that's just a quirk of the calendar. If you're just to find all instances where the market's gone down in any 24-month period, forget the fact that it's December, there have been 15, 20 of them.
So let's put everything in context for the folks, because I like to have them leave an interview with some tools of, what do I do given the environment,
Yes, please.
Right? And the last time you were on, again, was peak inflation, you said, own gold, own oil, stockpile cash. Now that, like I said, inflation is cooling, we're going to see less tightening for the moment. What do we do?
Gold, I think, remains number one of precious metals in general. And then within the market, equities, my hunch is to have healthcare as sort of a major overweight, both at the defensive end, big names like Merck or Amgen, and United Healthcare, as well as speculative securities. And I would just own the XBI, which is the biotech ETF that captures a broad swath of small and mid-cap companies that are on the mend.
Fantastic. I could not have asked for a better historical overview to really prepare us for this year, Carter. Thank you so much for bringing your charts and for educating us.
Onward and upward, or downward. Thanks so much.
Hopefully upward. Hopefully upward.
Yeah.
All right, we'll have more great content. We're just kicking off the new year. Who knows what's in store, but we're going to be in it together. So continue to stay tuned. More great content coming your way. Sign up at danielacambone.com. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.